Front and center this hour, the state of the AI trade. Many of the biggest names down again today. Has it left this market vulnerable to a larger pullback? We will discuss that with the investment committee. Joining me for the hour today, Josh Brown, Joe Terranova, Bill Baruch, and Jim Lebenthal. So we've said stocks are down again, which they are, across the board, not by a large amount, obviously, but nonetheless, the consistency of today's move is one that we're watching. Rates are an issue. And they really have been since the Fed cut. Rates have been moving up. They're up again today. You look at the 2, the 10, the 30. 2-year was at 355. They're 365 today. The 10-year, 408. That was before the cut. They cut, now they're 418. The 30-year, 468 before the cut, now at 477. Outside of Stephen Myron, of course, who's advocating for many, many rate cuts, more of the commentary of late from Fed officials has been a bit more cautious. So why don't you set the scene for us, Josh? It's good having you back here post 9 in person on how you think on how you think this market looks. And then I want to really lean into some of these headlines that Ken Griffin made within the last 30 minutes or so.
I think it's vulnerable because it's while it's broad and we've seen rallies away from tech, we can't deny the fact that tech is really what's fueling the enthusiasm overall. And I think when you look at the give back in Oracle over the last couple of days, Oracle is an outstanding company. It's not a judgment of the fundamentals, but to take a stock like that up 40% on news that they are now willing to go negative cash flow and take the AI arms race into a brand new paradigm, because prior to that, it's companies spending out of cash flow. Now it's a whole different thing. Now we're talking about debt levels. It's starting to look more industrial to me, and that's why rates all of a sudden matter, especially the 10-year, but while it's not as low as it was, not as high as it was, at the highs at 5%, it's still hanging up there, and that's a really big factor when you're financing projects out of debt. So I think that's now become an issue for the technology market. The NASDAQ itself is in the midst of one of its longest win streaks in 50 years. Today will be the 102nd consecutive close for the Qs above the 50-day moving average. Not the 200-day, the 50-day. Think of what a rally like that looks like historically. There have only been 7 other instances of a longer streak, and if we go another 30 or so trading days above the 50-day, that'll be the all-time record streak. So
I'm glad you bring that up. Let me just interject for a moment, because I'm really happy you brought that up. So there's a stat out there today that, well, what Josh says is you're getting close to the point where similar streaks have come to an end, which is, I think, part of the point that Josh is making about the vulnerability of the market. The highest since 2017, remember, so we've done 101 trading sessions where the Qs have closed above the 50-day moving average, okay? Since 2017, the highest has been 107. Today would be 102. We're down, though, so maybe we don't get it. But the highest would be 107, and that was since 2017, the point where similar streaks have ended in the past.
So here's the thing about bull markets. I'm an internals person. I know a lot of people say disregard it, ignore it, but I've never been able to. AI-related stocks have accounted for 75% of the S&P 500's returns. So not just NASDAQ, but the overall market. 80% of the earnings growth for the S&P and 90% of cap spending growth since ChatGPT was launched. That's according to my friend Michael Sembelis at JP Morgan.
Does amazing research on a whole number of big picture topics.
Correct. So you've got a ton of concentration, not just in AI in the NASDAQ, but AI in the S&P. And when you look at the internals, 59% of stocks in the S&P are above the 200-day, which means obviously 40% are not. So while it's a broader rally than some might give it credit for, it's not all that broad. And the reality is, when you have a streak like this, people get super comfortable. People start doing wild things, like gapping up a name like Oracle 30 or 40% in a day. And when you see that level of enthusiasm, where that comes from is people forget about the other side. They forget that risk exists. So I think we're vulnerable, to answer your question. Mm-hmm. Those are the reasons why. I don't think that's the death knell of the bull market. But my God, if there were ever a time to say, maybe I don't need to add my next stock without taking something else off or lightening up exposure, this is that time.
Maybe that's the perfect segue then to lean into a little bit of what Citadel's Ken Griffin was just saying a little while ago on CNBC, and specifically around the hype and the spending around AI. Those are my words. His words are, quote, "There are certainly echoes of the dot-com bubble in this moment." As Joe, he looks out there and he sees what's been going on in the flurry of announcements in the past few days, all these billions and billions and billions of dollars being laid out for capital expenditures by various companies, the way that investors have chased these stocks up to the moon. Yes, there's been some fits and starts here and there, but what do you make of what Ken Griffin said there? Echoes of the dot-com bubble in this moment. If you take what Josh said from Symbolist, 75% of S&P 500 returns have been from AI-related stocks, 80% of the earnings growth, and 90% of cap spending growth since ChatGPT launched in November of 2022. In other words, there's been the whole game in town. For the most part.
It has been the whole game in town. It's been that way since 2023. If you think about coming out of a very punishing period in 2022 when the Federal Reserve was raising historically an aggressive hiking cycle, where would we be without the innovation powering forward a lot of the earnings growth that we saw from these technology names? So you have to take the good element of that and then understand that markets are very consistent in taking things to extremes. I like Josh's point on Oracle because Oracle is announcing a $15 billion debt offering. So that's where you get the echo, Scott, of 1999. When you begin to say, okay, this is not cash from operations. This is now we are going to go access the debt markets. We're going to raise capital, and we're going to use that to spend on the infrastructure. And that's exactly what Oracle is doing. It's one of the reasons why Oracle is on the retreat over the last several days, because they had announced that. They're at $91 billion worth of debt. That's second highest to Apple. But don't make the comparison to Apple because we're talking about two completely different companies there.